Hello. Hello. Hi. Welcome to the COVID-19 impact on foreign evaluation webinar. My name is Max Fonarov. I'm a Chief Fair Value Officer and founder of Cerberus Advisors. Our firm is a full-service valuation firm that helps companies with financial reporting, tax compliance, and transaction planning. Naturally, we do a lot of work in the foreign evaluation world, but more broadly, we specialize in individual security valuations, business interest valuations, financial instruments, derivatives, debt. A significant part of our practice deals with purchase price allocations, valuation of intangible assets, impairment studies, and such. And many of the companies that we work with are technology-based companies, and that is also defined rather broadly. We work with IT, software companies, life science companies, e-commerce, consumer product companies, business product and services, and financial institutions. In this presentation, I will go pretty fast. I'll start with the background on 409A and the kind of imply intermediate knowledge throughout the presentation as we go through the concepts and how COVID-19 is affecting this type of analysis. I'll go through traditional valuation methodologies, how to look at the financial forecast in this new environment, and then go specifically through how COVID-19 impacts the model. And at the end, I'll go through the decision tree as to how to look at whether the new 409A evaluation is required and when and what have you. So Internal Revenue Code section 409A deals with deferred compensation. In fact, it's a tax break, and it allows taxpayers to defer or avoid tax liability while receiving valuable financial instrument. In most cases, it's a stock option. Just like any tax break, there are certain limitations on how much you can use it. And specifically, when you issue a common stock option, then the exercise price of that option cannot drop below fair market value of the common stock itself. So therefore, we tasked with determining fair market value of the common stock so that we don't violate this requirement and don't get exposed to the penalties and additional taxes. Now, fair market value, there is a definition in Internal Revenue Code of fair market value. It's very similar to the definition of fair value in financial reporting. And it's a price at which the property, in our case, shares or common shares, would change hands between willing buyer and willing seller. Generally, the assumption here is that the transaction takes place in orderly fashion, and the implication is such that the price would reflect the true economic value of the security that's changing hands. Now, fair market value of the private company is actually more volatile than the fair value or fair market value of the publicly traded company. And so when you see the graph of one of your publicly traded peers, chances are the your private company is fluctuating more than that. And a lot of times you will actually see that assumption incorporated in many of the 409A valuation analyses when volatility is being calculated. But obviously, it would not be practical to rerun 409A evaluation daily or weekly or hourly or what have you. And Safe Harbor rule allows companies to run under regular sort of normal course of business. You can rerun your 409A evaluation only every 12 months or upon the occurrence of a significant event. Now, in most cases, this significant event has to do with a new round of financing and specifically equity financing, although a significant convertible round may also precipitate another 409A evaluation. Another significant event may have to do with the business-specific developments. And so imagine you have a pharmaceutical company that just discovered the cure for COVID-19 virus. That would be that triggering event to run another 490 evaluation, even if the last one was done just last month. Significant macroeconomic events can be another trigger for a new 490 analysis, and clearly we're here because of really dramatic macroeconomic events precipitated by this pandemic. Now here is a simple graph of the S&P 500 index. Now, intuitively, early in the year, we knew that something is coming, and we could suspect that, we could see that in the news, there was some anecdotal evidence. But really, in the valuation world, you need numbers to prove the point. And so, therefore, here, the S&P 500 index gives you the first indication of the fact that things are getting worse. So when you look at the index dropping 31% by March 23rd, and that day even the trading was halted, and I believe there were a couple other days where trading was halted, we know that crisis is becoming very significant for everybody in the economy, and certainly from the 490 perspective. So this is the first sort of numerical visual indication of that macroeconomic event. We can certainly look at other indices. We can certainly look at yields on bonds that went through the roof through the same period of time. However, the index recovered a little bit, and people are actually wondering whether it's really reflective of the true economic impact of the pandemic currently having on the economy. But looking at this graph, we still need to bridge between the S&P 500 movements and the valuation of our companies under Section 409A. Clearly, we cannot just take 31% discount to the valuation that was done on 12/31/19. So really, in order to understand the impact, and it will vary company by company. Some companies will see reasons for the impact, or the impact itself, or not. But really, you have to dig into the model itself. And so the typical 409 evaluation analysis, even though it can be structured in many different ways, different scenarios and such, but the three main building blocks of the 409 analysis is the business valuation, its equity allocation, and the discount for lack of marketability. Now, business valuation is typically done using three basic approaches, and most of the time it's actually just two approaches. It's income approach and market approach. Income approach relies on financial forecast, and market approach relies on market multiples. Clearly, financial forecast is going to be affected for many companies. And by the way, here on the slide, things in blue are the things that we would expect to be affected by the current situation on the markets. So the financial forecast is clearly being affected, so as market multiples. The income approach is a little more precise, and it's really true fundamental way to measure value, because the value really comes down to how much cash you're going to get out of something. And so the income approach measures that. Market approach is sort of a shortcut to the income approach. We don't bother ourselves with the financial forecast and the discount rates and what have you, and we simply take the current or maybe immediately forecasted financial performance of the company and use some market multiplier that we get from the publicly traded peers. Now, income approach is obviously a lot more subjective, although it's more precise. Market approach, while it appears to rely on observable market data, it can also be extremely subjective in the way how you actually derive those applicable multiples, because rarely do we find the exact peers trading out there in the market that we can rely upon. And so there's a lot of judgment goes into selecting those market multiples. And and how they actually being applied. So clearly, business valuation is affected. Now, equity allocation step of the analysis. The equity allocation, you essentially come up with a business value, but then you have all different types of shares in the capital structure, and you have stock options and warrants and preferred and what have you. And each one of them has different value. You cannot just simply divide by the fully diluted number of shares. That would not be correct. So in order to develop or understand or value a common stock, in this case, you have to perform the allocation. The most common model that is used to perform the allocation and determine specifically the value of the common stock, or you can determine the value of the preferred stock, or you can determine the value of your warrant that way, is option pricing method. Option pricing method, really the wheels of the option pricing method is Black-Scholes formula. The Black-Scholes formula, there is actually several of them in the common setup that reflect the company's current capital table. But outside of that, the most impactful inputs there are term and volatility, just like your regular Black-Scholes formula. So one might expect that if you extend the term or if you increase the volatility, the valuations will increase. And so that's a little bit not so intuitive, because typically we used to kind of not value things very highly if we exposed to more risk or a longer time to wait. But because the common stock in this model treated as a derivative, we actually end up with a higher value as we increase term and as we increase volatility. So other methods to kind of come up with the value of the common stock, really the only fundamentally different method is the current value method, where essentially it's a liquidation scenario and you calculate how much would you get if you sold the company today. The hybrid method and the probability weighted expected return method, those are other ways to get to the value of the common, but really fundamentally those are just scenario analyses, and it's the way to structure that overall for an evaluation setup. It's not necessarily any different methodology, so to speak, or logic behind coming up with the value of the common. Discount for lack of marketability is the last step. And discount for lack of marketability is also calculated based on option pricing formulas. One of them is a Black-Scholes formula, and there are others that are not Black-Scholes, but they're still responsive to term and volatility. So again, the longer the term and the more the volatility, the more discount you expect for the fact that you can't simply sell those shares on the open market. Now, interestingly, and you can see the arrow here on the left-hand side, allocation model and the DLOM model, they may actually kind of compensate, because if you increase the term and you increase the volatility, you increase the value of the common stock before the DLOM, but then you will also increase that DLOM. And so they kind of cancel each other out. This relationship is not dollar for dollar, and as always, you have to be careful in developing these assumptions. But we would not necessarily expect a significant effect on the outcome of the 409 evaluation simply because we're looking at the longer term, possibly right now, to execute on that business plan, or greater volatility of the financial instruments in the market. So let's talk a little bit about the financial forecast, and that's really the key. The common reservations against relying on the financial forecast is the uncertainty, and then also the lack of visibility. So uncertainty, you always have uncertainty, and lack of visibility is even worse these days because we don't even know what shape the recovery will take, or how long or how far, what have you. And so what's helpful here is to really think about financial forecast as a framework to plan for the future. It's a framework to express your business plan in numbers. It's not an attempt at guessing future financial performance. In other words, if you're just sitting there and thinking, oh, okay, you know, like what my revenue is going to be, is it going to grow 20% next year? Is it going to drop 10% next year? We don't know. But really, the good financial forecast would be dependent upon factors that underlie that change in the financial revenues or profitability. So the financial forecast can be created as a top-down analysis or bottoms-up analysis. It would typically deal with concepts such as addressable market, volume of product that you can sell, prices that you can charge, market share, you know, cost structure, R&D investments, other capital expenditures. So the good financial forecast would have all those details. And so again, we cannot necessarily forecast for the future, but a lot of times you can control these inputs because you have more of the detailed on-the-ground information about, for example, what price can you charge for that product. This is something that can be analyzed and determined with certain degree of understanding or precision, let's say. So the good financial forecast is the evidence-based financial forecast. So you definitely want to use the numbers that came from somewhere, not just guesses, but really would rely on a particular understanding of your market or precedents in your industry. So for example, how fast a competitor was able to ramp up to the certain level of operations, how long did it take? Industry cost structure is another way to kind of make sure that your forecast goes in the right direction. Very frequently we get the forecasts that, you know, scale to hundreds of millions or billions of dollars and preserve that 65 or 85% profit margin. So that is clearly not taking into account all the expenses that the companies will have to go through to scale that much. In the recent example, we were looking at the forecast of the software company that didn't have R&D line in it or had sub 10% sales and marketing expense. And very simply, you can look at the recent IPOs and those companies, they might be, you know, just over 10 years old, but they're still running at the loss. So the financial forecast has really to be business forecast. It cannot be a product forecast. And if you're running at the very high margin as a result of this analysis, there's probably ways to revisit and redirect. Obviously, looking at the peer companies in your space would be very helpful in looking at that forecast. Typically, the valuation specialist has to look at the forecast pretty carefully and kind of understand, certainly not at the level the management understands it, but be able to identify some of those big issues with the forecast and you know, not necessarily just adjust for them based on you know, the tools that we have, such as say discount rate or market multiples, but really have a dialogue with the management about whether this forecast really makes sense. And so how does the current pandemic affects all those inputs? So again, let's first talk about the forecast. And here, by the way, on the right, you see the chart. There's a few scenarios how the economy may recover. Obviously, nobody knows. Those are just economists speculating based on you know, whatever analysis they currently do. Just today, the new economic numbers and came out, and GDP dropped in the first quarter by, I believe, 4 and 8%, and that is certainly significant considering that pandemic didn't really hit until the second part of March. But first, the financial projections, the projected financial information, the term you will always hear, or abbreviated PFI. The timing of that forecast is the first kind of obvious thing you can always adjust. Like even if you don't expect significant impact on your market or your addressable market of this pandemic, maybe you can look at it as simply a delay. then at the very minimum, you can take the financial forecast and just move it out. You know, you can move it out by 6 months, you can move it out by 12 months. It certainly, again, depends on your best judgment. But that's the simplest approach you can take, and the most direct kind of minimal step you can take in financial forecast is just simply delay that revenue ramp. The second, and so with that, you can delay revenue, you know, R&D expenditures, other expenses or investments that the companies are making. The demand curve is something else that you can start considering as well. So again, I think most of the economy is hoping that this is just a delay and we can somehow get back to normal, while those businesses are going out of business. And so it would not be unprudent to revisit the demand for your product and revisit those uptake curves. There are different shapes that are cited out there. It's a V-shaped recovery, U-shaped recovery, W-shaped recovery. That's where you have that second wave of infections, or L-shaped recovery, something like Japan, where it kind of, it's down and it stays down for a while. And for many startup companies, you know, for a while, you know, 2 or 3 years could be all the time that they have to kind of recover. So, so thinking about the demand and thinking about how current situation will affect your operations in the medium to long term would also be prudent in this case. Now, typically in the 409 evaluations, you don't see scenarios, various forecasted scenarios. I mean, you can see scenarios about different exits in the P-worm analysis, but you would not necessarily see you would not necessarily see the different forecasts. And so it may actually start making more sense to consider forecast scenarios. At the very minimum, you can look at the 2 scenarios. One is your sort of regular expected growth, coming back to it in a 6 or 12 months. And then the second scenario is just a survival, you know, just trying to keep the lights on for a while. And so separating that second scenario would actually give more visibility into why the stock price went down and when it recovers. So over time, if that survival scenario becomes less relevant, you would reduce the probability or weight of that scenario. And as you track and going future forward with the 409 evaluation, you will notice that you know, elimination of the survival scenario is a driver of the increase in value. So that's a little more detailed and a little more transparent than simply changing the discount rate at the top line, at the top level. So that would be one of the recommendations. I mean, of course, many scenarios are possible, and I wouldn't necessarily recommend swamping your 409A specialist with 7 different scenarios. It's just not necessarily practical. And when you deal with a lot of scenarios, I mean, while it makes sense that initially, then you immediately have to decide what probability or weight to give to each scenario, and that becomes just hugely subjective. And again, we typically suggest that clients keep those scenario approaches contained, so to speak. Now, other valuation assumptions and inputs would be, as I mentioned, the discount rate. So you can expect a higher cost of capital and higher return on your investment if you put money in the market right now, including putting your money in those companies that need funding going forward. Let's talk a little bit about market multiples. So the market multiples obviously sensitive to the market prices out there. But the market multiples, typically in most 498 reports, they're really point estimates. So you choose the valuation date, and on that valuation date, you calculate the market multiples of your peers and you apply them in your analysis. Obviously, if you go back to that chart of S&P 500 and choose March 23rd as a valuation date, that would not necessarily be representative of a long-term view of what your company's value is. And so because when you face so much volatility, it could be prudent to kind of consider looking at the market multiples on some kind of running average basis. So let's say, and just kind of shooting off the hip, saying a market multiple that's based on 10 days of trading, not just 1 day of trading of the comparable public companies. Another kind of approach for market multiples is to really shift the weighting towards the forward-looking multiples as opposed to historical multiples. That is also something that would be more reflective of the outlook for the future, as opposed to still relying on 2019 numbers that may not be relevant for many businesses going forward. Guideline transactions. Multiples based on guideline transactions has always been very deficient. I mean, every once in a while you can find that perfect diamond in the rough comparison and use that multiple. But for the most part, when we look at the population of guideline transactions, those are in the past. A lot of times you have to go 3-5 years back. And so obviously the valuations that companies were able to achieve last year may not be applicable going forward. So we would expect the guideline transaction method being kind of minimized going forward, or at least in this type of environment. And then I mentioned before, kind of switching to that from just a single scenario OPM analysis to potentially something like a hybrid approach. So the hybrid approach is a 2-scenario analysis. One scenario, things go as usual, as normal, so to speak, and the second scenario is where company either fails or it achieves the IPO exit, for example. We use this approach a lot for pre-IPO clients. And in that case, that one scenario that we carve out and consider separately is the scenario where a company goes public. In this environment, for companies that struggle to raise funds, that one separate scenario could be the scenario where a company can raise money, or maybe raises money at the very unfavorable terms. And so considering a couple of those scenarios, one of them is a pretty dramatic one, and another one is business as usual, so to speak, or recovery as expected, so to speak, then that may make sense in this current environment and probably going forward another 12 or 18 months. But then that's a speculation. Nobody knows how long and how fast. And so this is our last slide. And so I want to kind of summarize what we talked about. So the flow chart here on the left, first, we have to determine, do we need that next 498 evaluation? And unfortunately, the answer is probably yes in many situations, because we did have a significant financial market shock, and we did have a significant shock to the economy. The numbers that we're looking at right now are really dramatic, and it's the unemployment numbers, it's the GDP recessionary numbers. All those things point to kind of uncharted territory, and I don't have to spend more time on it. You hear it every day, many times a day. However, you can sharpen your pencil a little bit and look at the impact on your industry, and different industries were affected differently. The simplest way to look at the impact of your industry is either to look at maybe some index that is tracking your your industry. Maybe it's just an ETF fund that you know about. You can and should probably dust off your last 498 report, find the guideline public companies in that report and see what happened to those guideline companies, whether they went down, whether they went down a lot, maybe they double in price, although that is probably unlikely in many industries. Now, obviously management has a front seat view of what's happening with the company. And so if you look at your current budget for 2020 relative to the budget that you prepared, let's say at the end of 2019, is it a significant difference? And if the difference is significant, and if the restructuring within the company is significant, then that's certainly an indication that you need another 498 analysis. Another area to consider is the financing environment. So even if the company is doing steady and things are more or less, normal, if you can call it normal these days, then another place to kind of make sure that things are okay is really the financing environment. Many companies, many startups, their business model really relies on continuous raising of future cash. And so to the extent that you have indications that the cash is becoming tight, I think broadly speaking, there are fewer deals and the activity in the VC markets are down. But if you have direct indications that, you had a term sheet out there and it got pulled, or, amount reduced, and maybe your peer or competitor is suddenly not able to close that round, those are indications for the higher cost of capital, and those are actually indications for reduced value as well. And finally, you have to think about whether you actually need it, right? Like the 498 valuation serves a specific purpose. It helps you set the exercise price. You also need that fair market value when stock options are actually being exercised. If none of this is happening, then you don't really need it. If the company is staying more or less steady and these types of transactions are minimal, maybe it's possible to delay some of those things for maybe a month or a couple of months until you get a little more visibility into the future. But generally speaking, if things are moving and transactions are happening, there's really a lot of stakeholders that rely on it. Obviously IRS, but we haven't really, I haven't heard IRS scrutinizing 498 reports. However, IRS does scrutinize the process of setting up and complying with 498, so we've heard that. But employees, boards, auditors, transacting parties, M&A due diligence, where we see 498 reports come up, pricing of the new acquisitions where shares used as a currency, all those things actually one way or the other rely on the 498 valuation, even though every 498 valuation report will tell you explicitly that it cannot be used for any other purpose. But currently, to kind of summarize, you do have an opportunity to lock in the lower price, so you can have a lower price for the stock option grant, and you can also pay less tax if you do decide to exercise the stock options. You can also grant stock as as compensation here, and even though you would have to pay tax immediately, currently it's the time to sort of get the lower valuation on that stock grant. There's no indication that 12 months rule is somehow extended or changed. So we still have 12 months, and if anything, the current events accelerated the need for the new 498 or the new fair value market determination. When you select the valuation date, it could be current date, it could be 3/31, it could be a specific date, so you can choose, obviously. A couple of things to consider here. First of all, of course, don't choose the valuation date prior to the drop of the S&P 500 index, because then you're not incorporating the effects of the current pandemic or effects on the financial markets. 331 would be a kind of convenient objective date to select because it's end of the quarter, you have financials for it, and it kind of makes sense to do it at the end of the reporting period. I would generally caution against cherry picking that date. So if, for example, you decide to go with March 23rd again, where the S&P 500 was at its bottom, then it's not going to be a problem with your valuation report, but what's going to be a problem is why did you select that valuation date? Like, did you actually cherry pick it? And the good valuation analysis would typically try to kind of smooth out the effect of that specific valuation date, but you typically have to kind of have a reason for it, why a specific valuation date is selected. And then finally, do those valuations fast, because hindsight is really a bad thing that happens in our world, in the world of 409A valuations, because you want to not be exposed to more changes on the markets there when you make those decisions. Your auditors will come back and say, well, didn't you know that we were recovering? Or other participants or stakeholders would question why the certain determinations were made. And so because those determinations are so subject to the kind of environment, the current environment, and people forget very quickly and bias takes over, we suggest to value fast, grant stock options fast, or exercise fast, and move on. So with that, I'll stop and open it up for questions. Okay, so one of the questions I see here is what happens to the backsolve analysis? So the backsolve analysis is something to just clarify is when the company closes the round, and then we have to determine the value of the common stock upon closing of that round. Typically, it's a very straightforward analysis that does not involve the traditional business valuation. We're mostly just using that option pricing model to calculate the value of the common. Now, this is the type of analysis that is very rigid. So a lot of times it's really hard to work around those numbers, and we kind of caution our clients in this type of environment. In part because, as I mentioned before, you can change the term, you can change the volatility, but your DLOM and your option pricing model, they will kind of cancel each other out. So there's not a lot of wiggle room there. And so the current triggering events, they actually give you an opportunity to kind of dissociate from that data point, because in the normal course of business, that data point kind of serves as a reference for a while, even could be like 2 or 3 years. People go back and say, hey, there was that your backsolve, why are you below, why are you above, or things of that nature. Now it's the opportunity to step away from it. At the same time, there are consistencies that ought to be preserved, and so the guideline public companies, how are they used, how volatilities are calculated, what probabilities or scenarios are used, the models and formulas they used in calculating DLOM. There is a whole host of those models that could be used. So there are points of consistencies that have to be preserved. Another question, what other economic indicators we should follow for the 409A purposes? So what are the economic indicators? I think most of the economic indicators paint a pretty dramatic picture. I think it would make sense to kind of keep track of the financing activity in the VC world. It sounds like many people are actually relatively surprised that broad market indices are not more down than they are. And just yesterday, I heard a little tidbit by Bill Gates, who also expressed kind of surprise at that. But I would say, yeah, definitely follow the level of VC financing activity. So that is something that would tell you whether the VC markets and whether the startup world is kind of returning back to normal. Personally, I was a little surprised that the Silicon Valley reacted so swiftly to the crisis, and certainly many companies are laying off workers and kind of downsizing operations or what have you, even though we would think that a lot of people there can work from home, so to speak. And so, yeah, VC activity would be one that I would certainly track. The credit markets is another one where really a lot of true economic trouble are brewing, typically on the side of the credit. And so if the credit being restricted, then that typically is the trouble. But generally speaking, I think situation in your industry, again, like I said, maybe find an ETF fund that tracks your software or your pharmaceutical sector or what have you. That could be helpful to just kind of keep an eye on it. What if the situation continues to change? So the situation will definitely continue to change, and that is true even when things are normal, so to speak, without a crisis out there. And so one thing I certainly wouldn't advise trying to kind of time the market and hope to catch the lowest possible valuation for those common stock, because again, people are actually surprised how quickly S&P 500 recovered, and for all we know, we'll end up with indices back to normal, so to speak, and that would imply the higher valuation or not such a deep drop so I would say that the situation will definitely change. Without sounding self-serving, so to speak, there is so much volatility, and the changes are so dramatic that companies that do want to track those fair market values carefully will probably end up doing one or two additional valuations or unscheduled valuations within the next, say, 12 to 18 months. Again, those are just guesses, but certainly would be prudent to start reflecting the current situation for the sake of giving employees the true and appropriate exercise price, and give more transparency to the financial statements. So with that, I will end the presentation. There were some other questions that came through the queue, and I will reply to them individually in the email. So definitely you will get the reply to your question, and certainly feel free to contact me directly. We're a small firm, and I will certainly be happy to hear from you. So thank you very much, and hope to see you soon. Bye.